Good morning, traders. Welcome to another Profiteer video. Today we are going to talk about the thematic landscape within the current market structure, and I have dubbed it Project Blade Runner. Quick bit on that. If you are familiar with the movie, I would say that the name is more so in line with what we're dealing with on a day-to-day basis. It's kind of like running on a blade. So let's get started here. Obviously, you know that today is a very important day in the market, and if you don't, today is FOMC, the economic outlook for the future, the interest rate decision, all of these very important things that define market movement and what is priced in based on our fundamental landscape and our technical landscape. All these things play into the coming months, and I would say the entire quarter and the entire year. So let's look at this chart here that basically shows us the rundown of all capital markets across the board. So you see that the S&P 500 here in blue is at an all-time record high. And when you look at what correlates, so emerging markets, places like Mexico, Colombia, really anywhere that is like second and a half or pretty much first world, if you will, the lack of conviction behind the global correlation to the S&P 500 is something to take note of here. Carry trade, obviously, if you're not familiar with carry trade, it's essentially things like the dollar yen, something that would appreciate with risk appetite and consistent growth, if you will, has sort of flatlined. World equities, as I said, just like emerging markets, are at a great slowdown. And even today, we're seeing that with the data that's coming out of Europe. CPI, GDP, it's continuing to confirm that there is indeed a slowdown. And there's a lot of opinions. And, analysts are saying that it's led by trade wars and led by uncertainty. But the real question is, when we put all these factors together, how do we design a functional trading strategy around them? You look at the Fed balance sheet, and we'll get into that more later, but obviously the Fed are in a position right now where they're required to inject more liquidity because the market just doesn't have it. And that is a concern that we should all take note of. When you look at the growth that we've seen this year since the all-time rally began in December, or in January, if you will, we've seen a decline in economic outlook from the IMF, the International Monetary Fund. They essentially cut the global outlook for gross domestic product from 3.2 to 3.0 for 2019. So a contraction. That is not something that we should take lightly. And again, when you look at the S&P 500 at all-time record highs, is that something that we are willing to give a rational, active bid for when the major economic major economic leaders and political figures and organizations like this one are essentially telling us that there is a contraction occurring in the global growth across the board. And this 3.5 to 3.4 is for 2020. So looking even farther ahead. So let's talk about liquidity. Liquidity is essentially the amount of capital available to support a current value or price of market or of current market activity. And you see here that in the balance sheet, the total assets that the Fed carries versus their surplus or deficit, if you will, is showing that they are basically being forced to put more liquidity, inject more dollars into the markets because there just isn't any to support these prices. And although that sounds extremely bearish and like we should not be in this point, we are. And how do we fuel risk on with this type of sentiment? And as I'm speaking right now, we're looking at the S&P 500 at the opening bell, and clearly investors are probably not really looking to be holding this sort of risk appetite until there's certainty. And those who are, I believe, are probably using some sort of contrarian view. What I'm trying to say is I don't really have conviction when it comes to how the market is currently trading based on what we're covering here. And again, that's my opinion, and that's why we're giving you this presentation, to give you a better idea of how you can sort of digest this and make decisions. So I'm sure you guys have heard about the repo rate, and the repo rate is just that the overnight liquidity that is available for businesses to use for free cash flow is essentially low, and the Fed is having to infuse more into that short-term liquidity. When we look at the S&P 500 and the New York Stock Exchange firm credit debt balance leverage here, we highlight the previous recessions of 2001, 2008, and then the sudden boom that we saw in 2016, and how that leverage correlates to the underlying benchmark average of the S&P 500. And you can take note that in 2008, we were way, way over leveraged. Today, we are approaching the same exact area. And I think that regardless of what you perceive as the leverage based on your current situation, it's very important to keep track of this and to be sure to understand what money or what capital is actually available within the markets and how long it can last in circulation. You have to realize here when you look at this chart that, say you're finally convinced, say you finally want to get into this market as a long-term investor. And obviously a lot of us are just short-term traders who are going to take advantage of the chunks of movement that we see in day-to-day price action. But it should be noted that most people, most Americans, most investors are going to want to get into this market and leave it as a long-term investment. And obviously there are money managers that don't trade intraday. They trade, quarterly or maybe monthly. But all in all, the amount of risk that you take versus the amount of reward it's hard to believe that if you wanted to get into this market right now and put, a large investment to wait 10 years, 20 years, how do you get conviction behind a comparison like this, right? So let's talk about gross domestic product. This week, we had a plethora of data coming in. When I made this presentation originally, we didn't have the data, and now we do as I present it. So you'll see the actual data that I've added. And it might look a little funky for a second, but we're just, for the purpose of education and discussion, we have here the U.S. GDP over the last few years, and you can see that we are currently still in a overall contraction. It grew year over year by 2% in the second quarter. So essentially now that you're seeing a 1.9% versus 1.6% expected, that would still be considered growth. But the thing that we need to be focused on more is going to be, how long does personal consumption last? How long does the idea or the excuse, if you will, that the U.S. economy is in control because of personal and household consumption, how long does that stand? And that's kind of when you have to look at that leverage situation. You look at businesses, you look at households, the amount of debt, the amount of overall leverage, student loans, everything that you put together, you have to ask yourself, when they're using personal consumption as a reason to say the economy is doing well, how exactly do you stand behind that when you know what's going on, right? And again, that's more of a subjective to my opinion, and there is data that says that I'm right, but I don't want to skew your guys' opinions. I want you to take this data and digest it on your own. So also, businesses have declined in expenses. They're not spending money. And usually if businesses aren't spending money, then why are households spending money? So we have to see how that evolves. And, guys, going into this FOMC, just keep in mind that the data that's expected today, the quarter point cut is already 95% priced into the market. That means there's a 5% chance that the Fed won't cut. So there's speculation going on right now that it's going to be what's called a hawkish cut, meaning that, yes, it's what we've expected, but the Fed has done 3 rate cuts, if that's the case. And this would essentially exploit that, if the economy is doing so well, if personal consumption is doing so well, if GDP is, adding to the growth, then why are we cutting rates continuously? Is it a race to zero? And when I say that, you look at Europe, the rates are below zero, meaning you get paid to borrow money. Okay, same goes for Japan. Japan has been that way for a long time, since the great financial crisis of the 90s for Japan. So when we look at Hong Kong, there's a correlation to China there. So remember that Hong Kong is autonomous. It's meaning that it's its own governing, capital system, and the recent outlook, and you can see Hong Kong Chief Exec Carrie Lam stated that the outlook was dismal, and that first priority is to end violence. These are things that you have to take into account, considering the amount of capital that is in Hong Kong and how that correlates to our relationship with China, and the concerns going over these protests and how it might lead to a geopolitical intervention from China. And I won't get too much into that, but these are topics that you need to dive into. And again, if you guys have questions, go ahead and DM me directly in Discord and ask me what you want to know more about, and I can make more presentations on sort of these thematics that I use fundamentally to set up my trades. Because again, guys, as you know, I'm a fundamental trader mixed with technicals, but fundamentals are my sort of first and foremost when it comes to setting up trades, because this is what I do for a living. So I need to have a very keen understanding of what's going on globally and what could happen and what might happen, right? Looking at France, you can see that we've been in contractionary territory for quite some time, and the data that came out today was an expansion from the expected, but year over year unchanged, and consumer spending was a decline year over year, as well as the current data print that was expected. So that is, again, it's you have to ask yourself, okay, if France is declining in consumer sentiment and spending, what does that mean for our future, right? Because the global markets are connected. Mexico's GDP, this is an emerging market, and you can see here that its GDP stalled this year and contracted in this current data point. And that, again, is not helping the situation overall, because it's not that one data point kind of leads to an overall conviction. It's how they all correlate together and how they sort of develop over time within the current price action. So here you can see that we have a chart showing us the manufacturing activity compared to the 10-year, 2-year yield spread. And you see that in 2008, as the yield spread increased, our manufacturing activity had declined significantly. And we're sort of approaching that sort of inversion that we've seen in previous recessionary territory. And that is a concern. It's a concern that we should all not take lightly. And note that there's currently a lot of concern that the manufacturing is a part of what's causing this slowdown. And the Feds have stated that. And that is why the market is expecting them to cut rates in order to stimulate the economy and to avoid any sort of recessionary fears that may be priced into what's going on with, trade wars. Trade wars are not just connected to China anymore. They are also now connected to Europe. As you know, the United States put tariffs on $75 billion worth of Airbus subsidies and agricultural goods. And that is a serious thing that we cannot forget. And if the EU retaliates, it's not going to help the situation. And in this chart, you can see that the S&P 500 is way in sky-high territory in relation to the hard data prints that you're seeing in our economy. These are the things that make up gross domestic product. Services are, I believe, 80% of, if not more, of gross domestic product in the U.S. And our GDP is the most important because we're the world's largest economy. So when you see this sort of disconnect in the data versus the risk appetite, it does cause for concern. And then here we have a look at economic data from Asian markets. And you can see that the growth has been pretty much stalling, and you could argue that it's in a sideways movement. But again, at what point do we see things start to turn, guys? Here we have the Citibank's economic health from or the report that they put out recently at the beginning of September. And although it is encouraging that the U.S. seems to be way above global growth, again, what is driving that conviction? What is driving that force? And that's the question that we keep reverting back to monetary policy. And monetary policy, guys, right? The idea of printing money, essentially, adding money to the system, injecting money so that we can continue to stimulate economic growth, so we can stimulate jobs, so we can stimulate production, manufacturing, services, et cetera, et cetera. And how do we do that? Well, we make money cheaper. And when we say we're talking about all global economies, all major centralized banks. And this is how we saw the bullish run after the great financial crisis of 2008. The banks essentially bailed us out and were able to inject enough liquidity into the system to essentially reignite it. But how much strength, how much effectiveness does that have moving forward? And that is really the question that everybody is asking themselves that's financially literate. And that's what I'm here to do, is to let you make your own decisions on what I'm showing you and the data that you've researched. In this chart, we can see that the Fed is still the most hawkish central bank across the board, meaning that they are still the most expensive to borrow from. And that's why you constantly hear from U.S. President Donald Trump that the Fed doesn't have a clue and that they should be cutting rates to negative, just like Europe and Japan. And you can look all the way out left that they are currently the most dovish central banks. The last quantitative easing cycle that was added to the European Central Bank's rates basically said that, in order to stimulate economic growth and avoid economic slowdown of concern, we're going to need to inject more liquidity into these markets and make rates as low as possible. You get paid to borrow money, essentially. You get returns the more you borrow from the government. And you can see all these other banks have essentially leaned that way because that's what the economy is calling for right now. As U.S. being the number one economy, what happens when we start to head that way? How does that affect everybody? Considering the data, considering the ISM, considering all the prints. Global stimulus to the S&P 500 is clearly the driver. It's clearly what has led to such conviction over time. And remember, guys, it's literally just printing money. I like to revert back to the story of the Roman Empire. In order to stimulate growth among, merchants and consumers and whatever was going on in Roman times, they basically took gold coins and melted them down with other metals like aluminum and copper to make them of more value and have more of them. So then, if you go to the merchant and you say, hey, I want an apple, the merchant says, okay, it's 2 gold coins. And you say, great, I have 4, or you know what? I have 6, give me 3. He's going to say, okay, sure, here you go. And then you keep coming back asking for, 6, and he's going to say, well, how about this? How about I give you, a better price if you buy more, right? Because you have so many gold coins, he wants to make a better profit. So when every business started doing that, every merchant started doing that, and every consumer started having more money, more gold coins to spend, eventually everybody had gold coins. And that's the main point, is when everybody has cheap money and when everybody suddenly has money, what is the intrinsic value of that money worth? Not what it was, right? Oops. Right now we're pricing in 95.7% of a rate cut today. And I would argue that that's not really what's important anymore. I would say that what's important now is what's expected for December. And that's what the market's going to be listening for today. They're going to be listening to try and see if whatever the Fed is projecting into the economic outlook for the rest of the year is what really matters going into the rest of the trading, the days and the months and the weeks, right? You can see that this is a little scenario set up by John Kicklighter of Daily Effects. You can see I've been using a lot of his content because he does a great job of laying all this out. So I hope that me translating it to you guys in a sense with my own opinion helps you. But I would agree with what you see here, that, it would be extremely, I want to say bearish, because I would agree with that bearish statement for the dollar, the value of the dollar, if we were to cut rates more than a quarter point. And again, the probability of that is extremely low. The probability of John, it looks like, is none. 25 quarter point cut would essentially remain neutral across the board because it's already expected, okay? And because it's 97% expected, it just, there's not much the only concern would be if there wasn't a cut, to be honest. It would be very bearish for the S&P if there was no cut. If there was no cut, then the market would be like, okay, well, what happened? I thought, we priced this in. So I hope that gives you a very straightforward idea of what the impacts might look like today at 2 p.m. Eastern. Whatever Powell says in his statement, if he says anything that might ignite volatility, obviously it's most likely going to be on the bearish side, because just think about this, you guys, okay? Think about this for a second. What is easier to do? Head into record high territory and stay there with conviction based on all the data that we're getting even today, which is not great? Or is it easier to just swing back into range and remain sideways? Just think about that, okay? So overall, this meeting is not the most important in the sense of what happens today, but rather this meeting is important because of how the Fed is going to lay out the following meetings to come. And also, guys, remember, there's Fed talk all week next week. So whatever happens today is just the beginning of your opportunities as a intraday trader. So, no need to rush. As you know, we've had the FANG earnings. We've got Apple today. We had Google. We had Amazon, all which were not really as exciting as a economy at record high or at record highs would essentially call for. So I'm not going to get into domestics right now, but we can chat about that in the Discord room. And then just covering Brexit, guys. So China trade deal, obviously, is the fundamental catalyst, and the Brexit is the fundamental catalyst with the sort of uncertainties that have been looming over the market. And we're seeing a positive progression here. The UK has agreed on a December 12th election to essentially make an overall decision, as well as made previous statements that there would be a no Brexit off the table, which has led the market to become a lot more positive. Okay. I hope that this overload of data wasn't too much. I made it because I wanted to try and give you a simple, broken down, quick landscape for what to expect today and how it all affects the overall system, and so that we can discuss it in the room and have a better understanding together of what a day like today means. All right, guys. We'll see you in the chat room. Take it easy.